Hey! He is going to be joined by, on stage, the gang is Lucy Gazmararian from Token Bay Capital, David Vachelier from Flowdesk, where he is the CEO of Asia Pacific. We would also like to welcome Claude Eginta, who is the founder and CEO of Nemo. And finally, Lawrence Chu. Lawrence Chu is the chairman of the VSFG Group. And with that, James, are you ready to rock and roll?
I am.
Take it away.
Thank you, and welcome. This is going to be the best panel of the day, and probably of the entire conference, so you are in the right place. I'm James. I run DigFin. It's a media business based in Hong Kong, covering digital finance, fintech, and digital assets. The reason this is the best panel is because we're going to talk about connecting all the other stuff that you've been hearing about with real-world finance. And Hong Kong is going to be, I think, an epicenter of this trend in its own special way. We've got licensing regimes here. You probably have heard quite a bit about it earlier today that will enable and facilitate licensed activities for virtual asset service providers. And there's a lot more to it than just them being able to allow people to trade large market cap crypto coins. I think that's actually just going to be a way in to do a lot more interesting things that will be able to bring these technological solutions to real world assets. In fact, it's already beginning here. We've got Lawrence at VSFG is a pioneer in creating licensed asset management products for crypto. And I think then it's just going to be further steps. So what we want to explore today is, what does tokenization really mean? What has to happen for it to take place? Because we have been hearing about this for a long time. What kind of assets are likely? What kind of regulatory regimes can work, both here, in other parts of the region, and around the world? And what are some of the gaps? What are the things we can do with them? What are some of the gaps that are remaining so that we can get to the point where we're using this stuff and it means something, not just for crypto natives, but also for people in the traditional world of financial services, corporates, and beyond. So that's what we're going to talk about. Now, who do we have up here? We've got two individuals who represent different takes on, let's say, the idea of making tokens. So Virtual Smart in terms of managing assets that are today Bitcoin, but it will be hopefully in time more than that. And then Claude, who's in the stablecoin world. So these guys are helping create things. David is working with a firm that helps people do stuff with those things in marketplaces. And then Lucy is an investor who is looking at this entire universe and trying to put these pieces together like a jigsaw puzzle and figure out how to create viable businesses around this space. So she's got like this bird's eye view. So I would like to begin with Lawrence. Lawrence, he's a well-known person here in Hong Kong. He's been a long-time investor in innovative financial solutions, including in blockchain-based finance. Lawrence, 2 minutes on Virtual Smart in terms of being a licensed fund manager, and then let's just explain how that works, and then we'll get into, from your perspective, what could be next.
Sure, thanks for this. Thanks to everybody coming to this panel and coming back to Hong Kong. So welcome everyone here. Venture Smart has always been a traditional asset manager, licensed, regulated, type 1, type 4, type 9. A lot of numbers and puzzles. So it has always been doing private assets, so packaging funds, packaging assets for its clients, wealth clients as well as institutional clients. I think my personal journey has been starting in the digital space way back in 2014, 2015 as co-founder of Kinetic Capital. And the reason why we split between a non-licensed versus a licensed business is that really back at the time, and really all the way until the last 2 years, the clarity on licensing has not been very, very good by governments, and it just took a long time to get there. We were very fortunate that in 2018, 2019, working with SFC in Hong Kong, we worked with the regulators to frame what would be the eventual path of what we see actually today. So it's been 6 years. So VSFG was able to receive the first license in 2020 actually to do 100% digital assets. And that time it was very basic stuff. Let's just do a BTC tracker product, hedge fund product, very similar to Grayscale. But we're competing against the non-regulated exchanges and products. So there wasn't really much to do. We were just trying to get the market warmed up, market participants interested, to understand, learn the space, pain points, and really just to be patient, to see what BIS, FSTB, all these global kind of regulators are trying to do in this space. And I think in the last 12 months, as things changed in the global markets, and as regulation became more clear, very fortunate that Hong Kong government has taken a very positive stance towards crypto, essentially, but also virtual assets in the form of tokenized assets to begin with. I think they're thinking about this as finance 2.0. So maybe I'll stop here, and I'm pretty sure I can share more about what VSFG does from a real-world tokenization aspect later on.
Well, let me ask you this, Lawrence. When we're thinking about tokenization, are we talking about taking an existing financial product and essentially creating a synthetic that mirrors that product in a digital format, or are we talking about assets that are created and born on blockchain rails as smart contracts?
That's a great question. I think both exist, but right now, as a regulated entity, I feel that my purpose in doing this is really to get the larger institutional market cap up. I mean, it's great that today Bitcoin and the entire sort of market cap is $1 trillion. But what does that mean? It's tiny, that's what it means. So how do we get wealth managers, institutions, and really mass adoption of assets to become digital? So I'm a big believer in technology. Eventually, we're going to get to DeFi. We're going to get to very creative things. So the pathway, the end goal is that the asset class, the world's asset class, will be much bigger than it is today, because we're going to be tokenizing creativity, imagination. I mean, it's endless. But unfortunately, governments don't get there tomorrow. Big banks don't get there tomorrow. So I think it's a roadmap. I mean, if you guys are all tech specialists here, in the field, it's all about tech product roadmap. It's all about getting from one stage to another. So yes, the baby step is what VS is doing, and we're making a number of announcements. I think we made an announcement earlier this week. On the equity side, we're doing tokenized equities with Soma Mantra. Soma, which is a regulated entity in the US. We're working with Figure and Provenance blockchain on real estate tokenization, right? Home equity line financing. All of this is partially wrap token, partially in a legal construct. So there's many other things that we're doing. Another kind of fun project I mentioned is we're tokenizing the Titanic. It's an IP. So when we tokenize the Titanic, we're, again, constructing it into a form that is a fixed income. So you're getting a share of the proceeds of the Titanic going on exhibition. So these are some of the initial things that we're doing because it's a bit easier for our clients to understand and to acquire and to invest in a fixed income type product before we go much broader into other assets, into trading, into other sort of derivatives of what tokenization can become.
Okay, there's a lot to unpack there. We'll come back. Claude, you're the other sort of person involved in creating stuff. You're in the stablecoin world. Just tell us a little bit about what Mimo is doing, and then let's extrapolate that, look forward.
All right. Well, first, Mimo is a stablecoin company. We are a company, and we have built a decentralized protocol. Those are two things that share the same name. It's still Mimo, except it's radically different governance models. One side is a company, one other side is that we're just users of a DAO. I just want to set this boundary because for what I'm going to explain, it's going to be pretty important in the way we tokenize assets. We have a Euro stablecoin that is like a purely, over-collateralized, typical, like DAI, Euro stablecoin, which was born from the fact that interest rates in Europe were negative, and that if you wanted to make a Euro stablecoin, you had no option but to go with over-collateralized, with something that was, that just made sense in the space back then. But then, the macroscape started to change, and you had higher interest rates, and we're like, well, if now bonds are going to pay, maybe we can look into making stablecoins that actually that are backed by some treasuries, the same way Circle does. And it was 2022. Felt like what would happen if you tried to make stablecoins in 2022? And we felt that the old model of essentially keeping the yield just for the company and having the users get nothing did not really work. Would be maybe we can do something by combining a regulated side that would just tokenize the bonds and allow some of the users, some of the consumer of the tokenized bonds, issue their own stablecoins into interest-bearing stablecoins. Could be a nice thing, essentially turning what USDC would be into a token that would essentially be similar to a USDC that pays people. So we would be doing this two-layer tokenization. We thought it would be a good idea, and we ended up building a decentralized part and a centralized part to take care of this. So this is what we do today. We're just enabling people to essentially create a market for stablecoins. And the reason why we went for stablecoins is that, as David would know because he's a market maker, providing liquidity to stablecoins is much cheaper than providing liquidity for the original asset, which price would be fluctuating. Now, they would not be totally stable coins because they would only be stable relative to the bond backing them. But we consider that this is an acceptable trade-off because crypto is still about education. And if people understand that, well, the price of the bond goes down, the price of my tokens go down, it's fine. It's part of the financial education that people have. Then we consider that it's a win.
What's the roadmap? What is your vision for turning this into something that people would be using? Would they be using it just for to generate a small yield, or is there a broader use of these tokens down the road?
Yeah, that's a good question. So, in terms of roadmap, the tech is ready. We just came out of audit, and we're currently in a beta program. The beta has been satisfying. We already have a good amount of TVL in the protocol, and we're starting with treasury bills. But our target is that we can tokenize pretty much anything that makes sense. So what can be tokenized into stablecoin is mostly debt, because debt, you can denominate the debt in the asset where the debt is originating from. Some debt of an American company would be a dollar stablecoin that pays. You would take a debt from, I don't know, right now, Aston Martin is paying 11.5%. We can tokenize this into a dollar stablecoin that pays 11.5%, as an interest-bearing token. And then we can tokenize equity as well. We can even have something that pays dividends. The model is rather flexible, and the moment this will be in the hands of everybody will be depending on the type of people we work with. But right now, we already have quite a bit of traction.
What's the advantage of using this versus just buying a bond?
Well, it's pretty clear. One of the reasons why RWAs were not working before is because it was done with the wrong assets and the infrastructure was not here. Now, well, we believe that there are assets that make sense. You have stable stuff like bonds that are now paying, where they were not paying for 10 years, so now it makes sense. And you have an infrastructure like DeFi, which is a pretty slick type of infrastructure. Now, what if you had all your DeFi strategies, half of which are based around stablecoin, that you could replace, plug and play, your stablecoins with an interest-bearing stablecoin. You would be able to leverage the entire DeFi ecosystem with much better assets. And this is where just buying a bond would not help you. Because if you buy a bond, you can't put your bond on Curve, you can't put your bond on Aave, you can't stay crypto native. And if we are believers that the DeFi world is going to grow, then you might as well want to use primitives and want to develop the primitive and the infrastructure to integrate within this world instead of leaving people. We realized that for a lot of companies, getting the yield from treasury bills meant leaving crypto. We just want to allow people to stay in crypto and still benefit from the infrastructure. This is why we're building this.
Okay, interesting. More to unpack. David, you are a market maker. You've got custody, brokerage, etc. So providing tools to people in the crypto trading world to do stuff. Right now, it's been, I guess, coins that you make markets in. What is the level of interest from your shop in terms of other types of instruments? Do you see demand? Are people talking about being able to make markets, or your clients want to have positions that you can make markets for them in things other than large cap crypto coins or something like that? Where are we at?
Thank you, James. So Flowdesk is indeed a crypto market maker. So we are providing liquidity in a various number of markets. At the moment, it's, as you say, mostly skewed toward tokens. But our vision from the ground up is that we believe the world is going to get tokenized. And for that, we are building infrastructure to connect to, at the moment, we are connected to 100 exchanges. And one of the things, you know, as part of this ecosystem, and when we tokenize asset, one of the questions that comes to mind after is the liquidity. Secondary market, where is it coming from? How do we ensure people can buy and sell those assets? So Flowdesk is doing two things. The first big pillar is building the infrastructure and the technology, you know, back to Laurent's point. And the second thing, and this is where we are building this innovative model, we are providing the traders to operate this technology as a service. So it's a key differentiator. And we believe that as the world is getting tokenized, you know, the possibility for end users to trade their own capital on different venues, which is a complex thing, right? But you can outsource that as a service to the kind of entities we are trying to build. And this is where we play a role in the tokenization.
So two things. First, let's talk about trading as a service.
Yeah.
Just to help us unpack this a little bit. You have the expertise to do this. Yeah. It's what you guys do. Yeah. So maybe a corporate hedging desk or a bank might want to use your service to help them either manage their risks or take a view, correct?
Yes, correct, yeah. Yeah, so we have this, but if you think, if at the moment, we think tokenized asset is a bit you know, far away. It's not. It's gonna be a real thing probably 5 to 10 years from now. However, you know, getting ready with a good working in trading infrastructure to exchange and to provide liquidity on those assets is a thing that can start to happen now.
Yeah.
Yeah. So when we say trading as a service, I guess one of the big difference is that most of the trading houses are trading their prop capital. And what we're trying to invent here is a service approach. So it's a bit like managed accounts in the traditional finance. And that's where we think the power of this is the removing of conflict of interest, for example. And as you all know, it's been pretty active on the exchange space very recently. And you know, exchanges can't keep trading their own exchange. So there need to be an entity that is able to provide regulated, clean, and transparent trading services and not prop trading.
Why does this, or perhaps maybe I'm ignorant, why does this make more sense in a crypto world than it might do in the traditional world of finance?
Because the crypto world is not regulated yet.
And if it's regulated like in Hong Kong, does this work?
Yeah, so we think we are very bullish in Hong Kong. It's the first time we come back to Hong Kong. We are in Singapore and Paris. So we are very bullish. We're having good discussion with Lawrence, and we see many people from Hong Kong, like the energy is back. And we definitely set up shop or people in Hong Kong in the coming months.
Yeah. Okay. And last question for you before we move on, David. What do you think will be different in terms of whether it's prop trading or trading as a service, doing this for coins versus things that represent, let's say a security or shares in some sort of illiquid asset. How will that look and feel different than what you do already in say Bitcoin or Ethereum?
That's a good question. So we see that at different phases. At the moment, it's coins only. Then we also, there is already market maker and a business model for market maker as a service for securities, but non-tokenized securities like ETF or equities on different exchanges. And the next step, of course, is going to do the tokenized securities, which is a security token, right? So we plan ahead to be there, to be the place of choice in 5 years' time when this happens. So at the moment, I would say, the world is heavily skewed towards tokens in the crypto world. But again, we see, back to your question, we see more and more demand on securities token.
Okay, great. Lucy, thanks for patiently waiting. But I'm saving the best for last, obviously. But you look at the landscape here as an investor. You're investing in projects and so on. So I would love to get your broad take. Tokenization, is that something that is going to be exciting now? Do you have projects on your, that you're looking at or investing in that are doing tangible things in this space, or are we still very much in a laying down tracks for maybe 3 to 5 years?
So thanks for having me here. If we're moving towards a token economy where everything's going to be tokenized, it's not just going to be financial products, right? It's not going to just be stocks, bonds, or other new types of financial instruments. But actually, we're seeing many other things get tokenized. Obviously, NFTs and digital collectibles, and even new sources of value like IP. And I hadn't heard of imagination, Lawrence, but did you say tokenized imagination? Yeah, okay. Anyway, so many new things to tokenize. Even Amazon is now going to start giving you an NFT with everything that appears on your doorstep. I'm not quite sure of the purpose of that. So I think that actually the innovation and tokenization platforms that are around now and innovating now are looking to the more sort of esoteric products that are not yet the path well trodden, which are the stocks, tokenized bonds, tokenized stocks, which actually the banks and existing financial institutions are already very advanced in how they're going to deal with these assets. But really the fringe area of tokenization and new platforms for new marketplaces on the internet, right? That's the great thing about the Internet of Value, is that there's going to be new trading communities all over the internet, and they're going to be trading a bunch of different stuff. So I would say that companies that are innovating now are working, for example, with private membership clubs, where now your membership is a token and it's a tradable asset. What is the framework for that? How are you bringing that community together? And it kind of moves to the sort of tokenized gated communities that are also springing up. So the point that I think is really important is that this token economy is happening in lots of different aspects of our lives. So obviously financial services, but also new parts of our lives, entertainment, digital collectibles, and tokenizing the Titanic. So I think that's all coming together really nicely. And we are likely to then have regulated platforms that can do both things. And I think it's important that we have innovation for tokens that are not securities, because once the regulators figure out what's a security and what's not, then that's going to dictate the types of exchanges and platforms and what licenses they need to have in place. And we'll probably see some sort of convergence. I'm expecting most things to end up being a security, depending on obviously the utility, rewards, or whatever you're getting when you hold that token. So I think it's a nuanced, and I think the innovation's happening from lots of different areas, and it's going to be interesting to see where it all comes together.
Where's the liquidity, though? Private membership stuff, maybe if you've got some rich people with a lot of money and they like this, okay, but is there going to be a proper secondary market and a real liquidity that you can create in some of these niche things that's durable? You know, I mean, the apes and all that stuff was hot when it was hot, but then it ended.
Still
and,
hot.
You know, I mean, OpenSea isn't exactly the
Gucci
life of the
just
party
partnered with
anymore.
you.
So, you know, versus, you know, the bond market, the Forex markets are massively liquid today. So, you know, just how do you think about that in terms of, you know, total market sizing and that sort of thing?
I think, you know, liquidity has been the sticking point since we've been talking about this for years. Where is that going to come from, and what is going to be able to facilitate that? Now, there are teams and protocols that are out there trying to really sort of group together essentially AMMs that we're seeing in DeFi, so liquidity pools, but for security tokens or tokens that are conforming to some sort of standards. And any participant that's a part of that pool is regulated and licensed. And so bringing together a network of those participants, but that is quite difficult to sort of get the ball rolling and get everyone on board. And on top of that, you've got it on Ethereum, it's open source, you're embracing public blockchains. So right now, you know, that's why it's very interesting to hear. I think the question I had for you is the liquidity coming? Are you seeing signs of liquidity? Because from certainly where I'm standing, it is still very challenging.
Yeah, thank you, Lucy. So I take that question. I think when it comes to market making, you know, a lot of people are thinking the liquidity and the organic liquidity of a token or tokenized asset should the responsibility of the market maker, which is not the case at the end of the day. What we are doing is pipeline and service. But if the organic demand for an asset is not there in the first place, we can't invent it. Right? We're not in the world of doing fake trading because that's what it would imply. So it's very important, and it's already the case in the token community as well, and we see that quite often. So organic demand for tokenized assets, for me, is an issue, and it will be linked with the liquidity indeed. But I think that's where an important point on the tokenization of assets is, you know, you have two big things for tokenizing assets: the technology on one hand, and then the legal issue. And I think the biggest blocker at this point is a legal issue. So if you buy a tokenized asset, what claim do you have? You know, under what jurisdiction? What is actually, where is it enforceable? Because that's the big blocking thing, right? It's not much the technology, and you know, once those two things are done, then providing liquidity on any marketplace with a market maker like Flowdesk is going to happen naturally.
Okay, so this pretty gigantic issue of how do you know who owns what and how do you prove it somewhere? Obviously, there's software is law, but I think we're seeing the limits to how far you can take that. So you've preempted what I wanted to do with the panel. So you've already answered the question of like what's a big challenge, right? So Lawrence, with the Titanic, let's talk about icebergs. Give us one big, I mean, David has provided one big challenge. I want to hear one big challenge, and then we're also going to wrap up with the one thing that you hope to see change to get past that challenge. So, Lawrence, iceberg, what's your biggest iceberg?
Our biggest iceberg right now is demand.
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 So not yet a marketplace for the stuff that you're making.
No one wants tokenized Titanic that's a bond?
Actually, I was just going to follow up one point. I mean, totally agree with what everybody said here. And my point about demand is that I think a lot of people are misinterpreting what tokenization means. They think tokenizing something means automatic liquidity. They think tokenizing something means they can sell something. That's not really what tokenization is about. Most people here invest because you want to generate returns. You're investing in a product. You're investing in underlying. You really don't care if it's tokenized or not, really, at this point. I mean, what if you tokenize your house you live in? You're not trading your house day in, day out. But I think some of the panelists here said, what does the future represent? It's different, really, assets that are valuable, that people say that has value, different communities. And also, technically speaking, it's really the second derivative, which is going to create the marketplace. which is where the liquidity starts to come in and the technology starts to play out. Like, because quite frankly, I'm not going to tokenize my house and trade it day in, day out and try to do stuff with that.
You might tokenize it if you needed to free up capital. And then you wanted
True,
to interact
true.
with a DeFi protocol
True.
rather than going to a bank and
True.
remortgaging your house.
True.
Yeah, but
Kinda-
in this
You
case,
just don't need to.
well, I mean, the thing with tokenization is that very often people forget to understand that, again, like as you're saying, you need to solve demand, and you only have a few ways to solve demand. One is like you make the thing more accessible. Like maybe a house is very expensive, making it in smaller chunks could work, but then you end up with a legal issue. I own 1% of the house, I want to redeem, what do I do? Kind of thing, right? So it's all about the types of assets you want to tokenize. Like not every asset is a good fit for tokenization today. Like the infrastructure we have, the legal frameworks we have, make it workable to tokenize some assets, not all of them. And I think a lot of people who misunderstand tokenization are misunderstanding like this part like very clearly. Another thing is, again, to the liquidity part that we're all talking about. It's again like liquidity is not going to come automatically, and sometimes you have to incentivize it and all that. But even if you want to incentivize liquidity, sometimes it's just real hard. How are you going to incentivize liquidity on a house? Like maybe it's just not ready for that. Legal framework, where are you going to enforce the property of the house and all that? Real estate has always been used as the thing that people wanted to bring in tokenization of real world assets. And I think it's a wrong example. Like maybe the Titanic is better. Maybe there's a couple of things. Like this is why we're going to debt. We believe it's better, but I'm fairly confident like there's quite a few things that are going to be better at tokenization. And membership of clubs sounds like a better fit. Like the demand will have as much demand as the club has. If the club has no demand, maybe there's another problem to solve. It's a couple things, but at least if you look at a lot of markets that have existed before tokenization of things, like CS:GO skins and stuff like that, a lot of like markets that were moving online, those things will survive tokenization quite well and benefit from it because then they will be trading in more places, they will have better infrastructure and a couple of things like that. Like we have to see tokenization as a way to enable maybe better tooling for some assets, but not some magical solution to something that was already in trouble.
Excellent point. Thank you, Claude. We got about 2 minutes left. So, Lucy, I'd like you to have the last word. And I want to ask you, we talked about the legal issues, we talked about the demand issues, we talked about the suitability issues. What's one thing you hope to see happen, develop in the marketplace in the near, like let's say this calendar year, that will get us to like the next level so that we're just further advanced, get that ball across the field?
I think a really important piece that it is there today, but it's still relatively small, but really money on a blockchain. So getting fiat currency onto a blockchain in a regulated, compliant way, it's really the oil for all the companies that are building how to make payroll, how to do everything. And Hong Kong actually is very advanced, so we are likely to be announcing stablecoin regulation next year, so that's definitely a first mover. And when we have that all tied up and everyone is aware of the rules, who can issue the e-Hong Kong dollar or whatever currency it's going to be, I think that's really going to give a boost to the whole ecosystem. That's going to give a boost to the DeFi protocols because now they have the other leg. We do have stable coins today, but we've seen how shaky those are. They seem to be under attack if they're algorithmic. If they're backed by crypto, it introduces other risks that you have to worry about. And even if they're backed one-to-one with the US dollar, of a US dollar in a bank account, you have to worry about the bank going down, which is this week's concern when we've seen, four banks fail in quick succession. So it's really getting fiat money. Now, I don't know how that's going to happen. Is that going to be CBDCs? Is that going to be tokenized deposits? Is it going to be a variety of stablecoins from private market issuers? But I think we need the clarity on what we can all use and to be secure in that. Because the most terrifying thing recently was all the startups having USDC and worrying about that depegging when SVB went down. So I do think that's a critical piece of infrastructure that I'm excited.
Great. I think we have to end it there. We are out of time. but we have time enough for the audience to give a huge round of applause to our panelists. So please say thank you to David Bachelier from Flowdesk, Lawrence Chu from VSFG, Lucy Gazmararian from Token Bay, and Claudia Quinta from Mimo. Thanks, guys. Merci bien.
And of course, Jim DiBiasio in the moderation. Great job, you guys. Claude, OK, c'était vraiment superbe. Lucy Gazmararian, thank you very much. Oh, photo time. Oh, yeah, Claude. Il faut prendre photo. On a besoin de ton beau visage dans la photo. Vas-y, très vite. All right, there we have it. Web3 fans. Look at that. Get your photos in. OK, the pro shots are good. And they've got it. All right, one last one. All right, thank you very much. OK, can't get enough of that panel. Hey, all right. Good job, you guys. All right, thank you very much, sir. Wonderfully managed.